In this week's video, we'll review the latest charts to help us answer the question, the market is sending clear messages. Are you willing to listen? We'll be looking at the economy, market leadership, small caps, gold, the equal weight S&P 500, regional banks, inflation, and much more. But first, let's revisit the popular topic of the stock market bubble. Here's the tweet that we covered in last week's video. You can find it in our X/Twitter feed. We've been talking about productivity for quite some time in these videos. There's an article in the Wall Street Journal on Friday. And Ray Dalio looked at the bubble topic on a recent LinkedIn post where he referenced numerous data sets, including the chart in the lower right-hand corner of your screen, to conclude the levels are not consistent with past bubbles. To answer the questions in this week's video, including the one on your screen, we'll be leveraging the concepts embedded in this quote. Someone can spend millions of dollars developing an elaborate interest rate forecasting model, and I'll bet you that over the long run, the bond market's forecast will be better. And here's the key. The general principle is that if you can give up your ego and listen to what the markets are telling you, you can have a huge source of information. When the market started to peak in October of 2007, the message from the XLP-SPY ratio, defensive staples relative to the S&P 500, began to change rather rapidly. This is what increasing fear looks like. We had a very similar look as the S&P 500 was peaking in late 2021, early 2022. Get the increasing fear look in the same ratio. This is what we have today in early 2024. This really doesn't look anything like this, nor this. Chart dated March 7th. How about market leadership? Chart on the left side of your screen is XLK relative to SPY, tech sector relative to the S&P 500. S&P 500 bottoms here in October of 2022. The Nasdaq bottoms very late in December of 2022. You can see the XLK-SPY ratio takes a risk-on and leadership look in early 2023. It's hard to argue that anything has significantly changed. Ratio still has a full-bore bullish look when we look at the 30, 40, 50, and 200-week moving averages. Obviously, that's subject to change, but that's the chart that we have in front of us, and we can basically say the exact same thing on the right side of the screen. SCHG, large cap growth stocks relative to the S&P 500. Since SPY has a heavy weighting to both large cap technology stocks and large cap growth stocks, it's fair to ask and answer. How do the same charts look if we look at the equal weight S&P 500 or RSP? XLK relative to RSP on the right side of your screen. If we look at 2024 on the right side of the screen, the ratio is clearly in an uptrend. We can make the same argument on the left side of the screen, looking at the standard S&P 500 SPY relative to RSP. Last thing the ratio did was make a new high. How about if we look at the equal weight S&P 500 relative to the standard weight using a daily chart? Moving averages shown on your screen range between the 20-day in blue and the 250-day here in black. Notice the slope of the slowest moving average, the 250-day, remains clearly down. The last thing the ratio did was make a new 52-week low down here against RSP and in favor of SPY. If this portion of the chart over here starts to morph into something that looks more like this, it's possible that RSP will begin a counter trend move relative to SPY. But at this point, we don't even have a look like that. Very similar situation here. This is the standard weight S&P 500 relative to XLK, the large cap tech sector of the S&P 500. It's very difficult to make the argument, given that the fastest moving average, the 20-day in blue, is on the bottom. The slowest moving average, the 250-day in black, is on the top, that this ratio looks like it's about to flip into a look like this. As always, a commentary related to this chart and every single chart that we'll cover in this week's video is based on the chart in front of us. We'll take it day by day. And as you might imagine, it's difficult to find ETFs that are trending relative to the leader XLK. There's only a handful of them. One of them is QTech. the Nasdaq 100 Technology Sector ETF. So we're looking at the Nasdaq 100 Tech Sector ETF relative to the S&P 500 Tech Sector ETF. And as you might imagine, the Nasdaq 100 Tech Sector ETF, much like XLK, is a large cap growth ETF. So it doesn't look like large cap tech is about to take a back seat to anybody at this point. And a fair question might be, well, how does the Nasdaq 100 Tech Sector look relative to the broader and more diversified Nasdaq 100 or the triple Qs? Is the tech sector portion of the Nasdaq 100 getting weaker than the broader triple Qs? It is not. The tech sector portion of the triple Qs is getting stronger relative to the triple Qs. The ratio on March 7th above an upward sloping 20-day moving average, with black, the 250-day moving average, the slowest moving average, near the bottom of the stack. Last thing this ratio did was make a new high in favor of the tech sector. How do bonds look on a relative basis? Left side of your screen, AGG, a diversified basket of bonds relative to SPY. October 2007 here, S&P 500 peaks. You can see bonds start to become very attractive relative to the stock market. This is an increasing fear risk-off look, just as we had an increasing fear risk-off look here during the COVID crash. How does the exact same ratio look today? It really doesn't look anything like this or this. In fact, it just made a new 52-week low. We already touched on this topic, but at some point, the rest of the S&P 500 has to start to outperform. That may or may not be the case, and it's more a question of timing. At some point, there will be a counter-trend move at a minimum. But if we take a closer look at RSP, the equal weight S&P 500 relative to SPY during the session on March 7th, 20-day moving average in blue here. This ratio has done next to nothing year to date to flip the trend. What can we learn from the law of supply and the law of demand regarding the conviction of market participants to own regional banks, KRE, relative to the S&P 500? Since May of 2023, this ratio has made some improvement in this window here, but it really hasn't done anything yet to flip the trend. The case to fill this air pocket here would improve significantly if the ratio can get to the other side of these moving averages and exceed this high here. We'll see how it unfolds. Mortgage rates have been high. Does that mean housing stocks are in trouble? Not at this point. This is ITB relative to SPY. Ratio made a new high in Q4 of last year and remains above an upward sloping 250-day moving average in black. Covered this question in detail last week, but we're going to expand on it this week with different charts and data sets. You may remember last week we noted that the chart of small caps in isolation had a constructive look, and that was good for the market and for current market leaders and for small caps. However, as we noted last week, on a relative basis, the second question, are small caps the best place for our capital relative to the charts in front of us from an opportunity cost perspective? The answer last week, based on the charts, was not yet. It's the same answer on March 7th, 2024. This is a counter trend move here, which began in 2022 and ended here in Q1 of 2023. So in some manner, small caps did outperform here, but that turned out to be a counter trend move within the context of existing downtrend. Like last week, the ratio chart has some work to do. And like last week, we're not closing any doors on any options, including small caps. We look at the anchored volume weighted average price chart last week. If we look at it on March 7th, a week later, really hasn't made any progress. This downward sloping line up here, a very long-term trend, and these downward sloping lines tell you right now sellers on a relative basis are in control. Even to get a counter trend move, we would want this look down here to morph into something more like this over here. This was 2020 Q4. On Thursday morning, I woke up and looked at 320 some odd ETF charts. And the message from numerous perspectives said that small caps have a headwind right now. All stocks, including small caps, had a long-term tailwind between the early 1980s up here and really this point here in early 2022. And that tailwind was related to refinancing costs, interest rates. So over the long term, when you're rolling over debt in here, for the most part, you're able to refinance it at more attractive or lower interest rates, obviously with some exceptions along the way when we have counter-trend moves. Hypothetically, if you refinance debt in here and you're trying to roll it over today, that is no longer the case. And this concept down here is something we have to consider when we're considering how much, if any, capital to allocate to small caps. From Bloomberg, U.S. small caps have more than 2/3 of their debt coming due in the next 5 years, compared with less than half for the S&P 500. So more than 66% here, less than 50% here. You can pause your video player to read this blurb from Bloomberg, but the concept is, if we see a decisive break in the small cap value relative to the S&P 500 ratio, it's possible that this headwind could calm down a little bit or even turn into a tailwind, possibly even in the context of a counter-trend move in interest rates. The chart on your screen is from Q4 of 2023, so it's fair to ask and answer. How does the ratio look today? Has it broken out? Has it signaled a decisive shift in investor sentiment in small caps relative to large caps? Using ETFs, small cap value relative to the S&P 500, March 7th, 2024, the answer is no. In fact, it's made little to no progress from a conviction perspective. And it's noteworthy. Look how far away the ratio is in March of 2024 relative to this high made here in 2023. And the ratio, noted in the Bloomberg article in Q4 of last year, remains below a downward sloping 250-day moving average. Thus, you can make an argument that the market participants, especially institutional investors, still believe that small caps face a significant relative headwind compared to their larger cap counterparts when it comes to refinancing debt. And if we look at the hurdles that this ratio faces, it's got a lot of work to do. This represents significant potential resistance in here, the orange box. We've got a downward sloping trend line here. The ratio hasn't even made a run at it yet. We would also have to clear this angle here eventually, which is also inside the orange box. So even if we get into this area here, that's still not a convincing move relative to the hurdles. In life and in the markets, no hurdle is insurmountable, but we're trading the chart in front of us. Another way to look at this is an interest rate-induced headwind based potentially on a secular shift in interest rates from a very long-term downtrend to potentially a very long-term uptrend. And notice the downtrend had numerous counter-trend rallies. So if this has flipped, there's going to be counter-trend periods where interest rates fall. So on the question of interest rates, common sense tells us, let's say hypothetically we were going to go into a deflationary depression or a deflationary or traditional economic contraction or recession. Most likely the Fed would be lowering interest rates. And typically that's good for bonds on a relative basis on the longer end of the maturity curve. Example, the ratio of 3 to 7 year treasuries relative to cash for the most part, 1 to 3 month T-bills, got a really big boost when the Fed turned on the spigots full blast and went to unlimited QE and took interest rates to very low level. You can see when that happened, small caps down here on a relative basis eventually got a tailwind and significantly outperformed SPY down here. Well, that started to change when concerns about the Fed policy, and inflation started to shift in this window here. Notice the ratio drops below the 250-day moving average here. This is not a good look for inflation and interest rates, just as the IWM small cap relative to S&P 500 ratio down here is peaking. And notice we have no significant improvement relative to this interest rate ratio, just as we have no significant improvement on the relative performance of small caps when we compare them to the standard weight S&P 500. This is hovering right around a new 52-week low in March of 2024. Is there any good news here? Sure there is. Slope of the 250-day looks like it's trying to flatten out. We've got a tight cluster here. So it's possible that we could get a breakout in this direction, somewhat like this here. And most likely, that would be good for small caps, especially on a relative basis. Now, that's something that may happen, but we have to offset this potentially good news that we just talked about with the tight cluster by considering how far away we are from the highs up here in 2023. I mean, this ratio is not close to making any significant new high or a trend flipping new high. In fact, the last thing that it did was make a new low below this area here of potential resistance. If you're a small cap bull, this is what you want to see, this and this. That's not what we have in the present day. I like this quote here from that Q4 2023 Bloomberg article. You can rent the small cap rally, but don't own them yet. What does that mean? That means that most likely, even if small caps outperform, it's going to be a counter trend move within the context of an existing downtrend, meaning you would rent small caps, try to time it, and then break your lease in here and get out. We all know we have to keep a flexible, unbiased, and open mind. So if this area in here can morph into something like this, we'll seriously consider adding small caps. But it's important relative to interest rates and debt and rolling over that debt to read this concept up here and understand it. It's based on the secular shift in interest rates. If you want to find that Bloomberg article, you can Google the title on your screen. It's a tedious and 7-day-a-week project. Relative to this and all of this, we are making good progress, and we may open up the new client window in the second half of the year. That's to be determined. Since this is a time-consuming and long-term project, we would greatly appreciate it if our loyal viewers could help us out on social media. Does the market believe that sticky inflation will spark a 2022-like bear market? When we try to answer this question, think of the concept on your screen. Think of this quote from Albert Einstein. Apply that same concept to small cap leadership, RSP leadership, regional bank leadership. In the trading world, the quote on your screen is trade the chart in front of you. And that includes recognizing when the charts in front of us change, when what is changes. And relative to all these charts, that absolutely positively could happen very, very soon, but thus far hasn't happened yet. Back to the inflation question. This is what it looks like when the market is concerned about inflation. This is 2022 here in January. This ratio had already made a higher low here in Q4 of 2021. This is what rising fear about inflation, the Fed, and interest rates looks like. This is what today looks like. It's almost the polar opposite. It's another way to look at it. In 2022, everything got whacked. Stocks and bonds. One of the worst years in investing history for the balanced portfolio. So it's not surprising that for the most part, 1 to 3 month T-bills, about as close to cash as you can get, significantly outperformed the previous leader, large cap tech XLK, in calendar year 2022 in here. Rising fear about inflation, Fed policy, and interest rates. This is what we have today. It doesn't look anything like that. So when we say, does the market look particularly fearful relative to this question? If we're using this concept, the answer is no, it doesn't appear to be particularly concerned. You want to look at it another way? Some managers have to own stocks, a mutual fund manager. For the most part, many of them have to be fully invested. So when you're concerned, as they were in 2022, they have a tendency to go to more defensive stocks, the ones held by SP low volatility. So this is what rising fear looks like. This is what Q1 of 2024 looks like. Blue, the fastest moving average on top here. Black, the slowest on the bottom. Just the opposite over here in 2024. How about dividend stocks, energy stocks, and/or value stocks? It's a nice broadening outlook here. Dividend stocks, VIG in isolation, clearing this high here from 2022, and clearly in an uptrend when we view the ETF in isolation. As you might imagine, there's a however coming. If we look at the exact same time frame and look at a relative chart of VIG, the Vanguard Dividend Appreciation ETF, relative to the S&P 500 or SPY, we can see it has clearly been in a downtrend that began in Q1 of 2023. Remember from last week's video, these are two separate questions. Is this a good-looking chart from a trend perspective? And is this the best place for our capital? Similar concepts here. Energy stocks, for the most part, consolidating, but on a relative basis, they've been getting weaker since Q4 of 2022. Similar situation, VTV, the Vanguard Value ETF. Nice looking chart in isolation, broke above this base here. VTV in isolation is moving from the lower left to the upper right, starting in 2023. VTV relative to growth stocks is moving from the upper left to the lower right over the same period. How about volatile biotech stocks? On a relative basis, unquestionably, they've made some progress since November of 2023 here. However, it's hard at this point to make the argument that this look here in 2024 is significantly different from this look here earlier in 2023, and this turned out to be a counter-trend move within the context of an existing and longer-term downtrend. The leadership case for XBI would improve if we could exceed these levels up here, day by day. Do the charts favor adding to foreign stock exposure? If we look at foreign stocks, VEU in isolation, the answer would be yes. However, on a relative basis, the answer is no, or at best, mixed. From November of 2022, VEU relative to the equal weight S&P 500 was improving in an impressive manner. But after this peak here in late May 2023, early June 2023, it's been moving from the upper left to the lower right and currently is below a flattish to turning down 250-day moving average in black. We'll see how it plays out. The stock market's had an excellent run since the October 2023 low, and thus, human nature says it's time to get overly concerned about some type of correction or give back. There's nothing wrong with being concerned, and there's nothing wrong with taking some profits. We just have to make sure that we do so within the context of our long-term goals. The expression, the trend is your friend until it's not, applies to all time frames. Thus, even in the context of a still strong and ongoing secular trend that tells us our position should be higher several years from now, and that aligns with our goals, at some point, the shorter term and intermediate term trends are going to shift into give back mode. And the concepts of not assuming anything and not extrapolating a chart, meaning if a chart's going up, you don't assume that it's going to go up forever, and if it's going down, you don't assume that it's going to go down forever. That applies to a 1-minute chart and a quarterly chart, and everything in between. We do have some DeMark 913s in hand on daily and weekly charts, even within the context of a very strong trend. A 3 to 6% pullback can happen at any time. It's 100% normal and to be expected. And within the context of a secular trend, every once in a while, not unusual to have a double-digit give back. Not a prediction in any shape or form. We noted back on November 18th of last year that semiconductors had a good setup. They still look very good from a long-term perspective. They've moved a long way. We've peeled off some profits, nothing significant. And how you handle this is when the long-term picture, the long-term trends still look good, you can take some profits, but you cap what you can do. That's what this is all about, and that's what this is all about. The data that we track here and the data that we track here helps us objectively assess how strong the market is on multiple time frames and helps us determine, again, objectively and unemotionally, what those profit-taking caps are. And more importantly, what's a prudent allocation based on the facts in front of us. Because we know being overly concerned about the items on the left side of your screen can be extremely harmful to the items on the right side of your screen, especially within the context of a secular bull market. There has to be some reasonable balance between how you handle a correction while remaining firmly aligned with your long-term objectives. Given what we know today, even if semiconductors have a pullback, even a significant pullback, the odds still say that SMH, XLK, SPY will eventually go on to print higher highs before this bull run is over. If that changes, then we'll have to reassess the probabilities. We're concerned about the primary trend. If XLK is in a primary trend relative to small caps, at some point there's going to be a counter trend move where IWM or small caps outperforms XLK. That's 100% normal and to be expected. We've noted it doesn't look like a bubble. No bubble is not equal to no corrections. Those are two different topics. And we want to say thank you in advance for any assistance that you can provide on this front and this front. We can't emphasize enough how important the concept on the screen is relative to our long-term objectives. And we all know, if we're going to effectively listen to only what the market is telling us now, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.